What's the use of having a Ferrari that has no brakes? Every time you take it out for a spin, you know you can drive fast, but you also know you could crash hard. The majority of traders are like this as they try to make money fast, but what they don't know is how much risk they're taking. Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be sharing with you 7 tips to keep you safe so that you can trade just as you like, but knowing you can always apply the brakes at the right time. I'll also give you my views on the Dow Jones Index and then get into this week's stocks. First, hit that subscribe button and click the bell on the right so you keep up to date with our latest videos. Also remember to tune in to our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. The stock market is a minefield for uneducated traders who don't understand the risks of trading. If you are someone who believes that the stock market is risky and you worry about losing money, then you are like the many others who apply a hit and miss approach to their trading. This is like someone driving that Ferrari fast, as it's great while you're moving forward at a fast rate, but it's not until you need to stop fast do you realise the full benefit of having brakes that actually work. The reality is that many take on too much risk when trading the stock market, when they could be getting better returns by taking far less risk. The thinking that it is only others that get burnt and not me because I'm too smart generally only hits home after you've hit that brick wall. Safely navigating your way in the stock market is a challenge for many, but you can increase your odds of success with some simple rules. A trader without solid rules and a trading system is greatly increasing their trading risk, and consequently they will blow themselves up sooner rather than later. I recall a conversation a few years back with a middle-aged guy named John. He had a wife, a couple of young kids, and he had worked for years in a labouring job, which was taking its toll on his body. He had read online how much money could be made in the market, so he set up a trading account with an online broker and started trading. Now, everyone who makes their debut onto the market hopes this will occur when the market is rising rather than falling. And the good news for John was that he had caught a wave and was riding high as the market rose. History demonstrates time and time again, however, that most traders are totally unprepared for when conditions change. And there is nothing more certain than conditions in the market will change. As mentioned, most never believe that the worst could happen to them until after it's too late. After all, bad things happen to other people. John called into the office one afternoon after I'd sent out an email about the risks traders take in the market, which really rang true for him. He knew he needed some help, but admitting this to someone was one of the hardest things for him to do. His ego had taken a huge hit when the market pulled back swiftly, wiping out his bank account and more. The good news was that John knew it wasn't just the fact that the market had fallen away that was the problem. It was what he had failed to do. As I listened to him tell his story, I could hear the pain in his voice when he recalled the events of the past couple of years, and I really felt for him. I also knew that what he was sharing with me was all too familiar for me to hear. Basically the same story that I've heard hundreds of times with a different name. John had just made a bucket load of cash from the market in a very short period of time. And this was far more money than he'd ever made in a year from his full-time job. But he made a fatal mistake and it cost him dearly. Now I want to share with you what he did so you might learn from his mistake. John was making so much money that he decided that he could make a whole lot more money by taking on more risk by using leverage. So he geared up his positions to the maximum he could borrow as the market rose. Now he honestly believed, even though he had no real education, that he was a great trader. He also believed he had finally found his calling in life. So much so, he actually decided to quit his full-time job and trade for a living. Now, there's nothing wrong with wanting to exit your full-time job. In fact, many of my students achieve this and go on to achieve even bigger goals. However, let me say first and foremost that it must be done the right way and with a proper plan, not using a hit-and-miss approach like John. Experience and the right knowledge would have told him that this approach was flawed and very high risk. But John did not have either, and so he was living in a false reality. John truly believed that he wasn't a gambler, but the market soon showed him what he was actually doing, in fact, was gambling, and gambling in a big way. It also showed him he lacked the knowledge and experience required. When the market eventually pulled back, he lost hundreds of thousands of dollars. And before you ask, yes, I've spoken to many people who have lost that amount and much more before waking up to what they were actually doing. Now, to make it worse, John had only just recently moved into a new home, and not just any home. It cost him 4 times the value of the house they previously lived in on the labourer's wage. His house of cards came tumbling down, and his whole perspective changed in a very short period of time. Instead of exiting the market, John began to take on more risk by chasing his losses, and he lost even more. Now, to top it off, he and his wife were fighting. He was angry all of the time and started drinking. He couldn't pay the mortgage on his new home, and he'd uprooted his children from their school and their friends for this new life. His wife eventually left him and took the kids. But here's the kicker. A very simple thing such as risk management, along with proper buy and sell rules, would have saved John from his demise. The unfortunate reality is that most venture into the stock market without giving these strategies any thought. The good news is that John hadn't given up. He finally admitted to me that he had no real structure to his approach and needed a system that would allow him to apply more discipline in his trading so that he could gain more consistency and certainty. After a long conversation, John came to the realization that he'd made 3 fatal mistakes. Firstly, he failed to properly educate himself. YouTube, books, and free stuff on the internet did nothing really to prepare him for what he was doing. Secondly, he did not understand the risks of trading, particularly when it comes to leveraging and how to manage this. And thirdly, he failed to exit his full-time employment with a plan. Getting this right is not rocket science, but it is likely to be the difference between you living the dream and you experiencing the nightmare. And the path you choose is really up to you. You can either tiptoe through the minefield like John initially did, or you can learn how to avoid the mines altogether as he does now. Just think about it for a moment. If you are driving that Ferrari with no brakes towards a cliff, but you don't know where the cliff is, firstly, what are the risks you're taking, and what do you do when you finally see that cliff and it's all too late? So here are my 7 tips I teach traders that I know if you follow them will keep you safe and stop you driving off that cliff or stepping on that landmine. Number 1 is that your biggest risk when trading comes directly from your lack of knowledge, skill, and experience in the market. Dismiss this at your peril. Do not think that just because you've watched many YouTube videos that you are getting a good education. Anyone with a camera can stand somewhere in their house and pretend that they are an expert. There is a direct relationship between knowledge and risk. The more knowledge, the better you are able to manage risk. And the best way to minimize your risk is to educate yourself properly before you trade. You need to recognize that what you pay now to learn properly is much less than what the market will take from you if you don't gain a solid education now. Remember, the market will always be there, but you may not if you lack the knowledge and skill. Number 2 is know the risk you're taking at all times. This means that every time you trade, you work out exactly what you can lose if something goes wrong. Now, you can only do this if you use a stop loss. Investing without a stop loss is high risk. A stop loss allows you to decide upfront how much money you are willing to risk. It's not what you stand to make that's important, but what you do not lose. Number 3 is that trading without a proper plan is gambling. We all know the saying, fail to plan and you plan to fail. And I think Warren Buffett got it right when he said, someone's sitting in the shade today because someone planted a tree a long time ago. Most traders I've met do not have a plan, whilst some that do not really know how to create a proper trading plan. Make no mistake, this process is critical to you reducing your risk and increasing your success. Number 4 is never buy a stock just to get a dividend. Always buy for capital gains first and dividends second, as the dividend is the icing on the cake, not the cake itself. Number 5 is never take tips, no matter how tempting it is or who it's from. It is far better for you to set up a watch list with 10 to 20 stocks that you know like the back of your hand and develop your own strategies to trade them. Hoping that someone else's tip will perform rather than knowing yourself is gambling. Applying someone else's strategies will increase your trading risk. It's vital you learn how to pick the right stocks for you and have the right rules that you know how to manage. One of my favourite sayings is give a man a fish and he can eat for a day, teach a man to fish and he can eat for life. Number 6 is never buy a stock because it appears cheap, as you will get it wrong nearly every time. Cheap does not mean you'll get a bargain when it comes to the stock market. If a stock is falling in value, remember it can and most likely will get a lot cheaper. Always buy quality shares that you know are rising, as these are the most liquid stocks on the market and are more likely to continue to rise. Number 7 is do not over-diversify your portfolio. Whilst it's true that diversification reduces risk, a portfolio that is over-diversified, which is more than 12 stocks, will generally mirror the market. Now, I recommend that most traders hold between 8 to 12 stocks in their portfolio. The longer the time frame when trading, the higher the number you should hold. Short-term traders may prefer to choose between 5 and 8 positions. Now remember, there are only 2 things we can control when it comes to the stock market: when you buy and when you sell. Therefore, it is essential you understand how to get both right so you can adequately manage your risk in trading. It's not good enough knowing how to buy if you have no breaks to manage your risk. Knowing how and when to sell is critical to your long-term success as a trader, and we can teach you exactly how to do that. Now, let's review the market and this week's stocks of interest.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Okay, I hope everybody had a good Easter and a good break over that period of time. I'm sorry I didn't do a report last week. I actually went away on holidays at the last minute, decided to go away and have a bit of a break myself. But the market still kicked on a little bit, although some really interesting stuff happening on the Dow Jones at this point in time. We really need to have a bit of a look at it. So looking at the chart is you'll see a monthly chart on your screen right now. And if I put my glasses on, I can see it a little bit better. But what I want to share with you is if I drag this down a little bit, this area in the middle, and if I use my trend line tool, I can just sort of show you this sort of pattern that is actually doing. And you can see this sort of pattern that looks a bit like a trumpet. There is a pattern called a trumpet pattern in the market, and it's generally a sort of a bearish type of thing. But what I'm showing you here is it's made a high, higher high, a low, and a lower low. And so you're getting that expanding pattern. And so it is interesting. It will be interesting to see whether the Dow moves up and goes through that previous high, that 26,951. Currently, last week, very, very short bar. If I just do that out a little bit so you can see it here, you can see last week's very short bar in terms of price had a range of 633 points. Closing at 26,543. Bit of indecision the week before. We had 1, 2, 3, 4 weeks up. It wouldn't surprise me to see the Dow fall a little bit. Now, I am expecting the Dow, if it doesn't break through here, I would suggest it's going to come back down below that low there of 21,712. Now, I'm going to show you something interesting. If I go back in time, if we look at this, and scroll back in time. Let's go back through to about here. So you can see here back in about 1999 we had this huge big sideways pattern with the Dow from about, what's that period there, that April 1999 right through down to October 2002. So there's 3 years where the market went sideways and then down. But if I drag that down, I use my same little trend line tool, you can see the same sort of little thing happening here where you've got that higher highs and lower lows. So in this little period here that we got from that period there, that's April 1999 through to, what about there, March 2000. So I'm not suggesting it's going to do exactly the same thing. We just have to watch to see whether it's going to do the same thing, because we might be seeing the start of the market tipping over. Now, it's not necessarily always going to be the case, so don't put it hard and fast. I don't think the Dow's going to crash, but what I do think is the Dow is not as strong as people are making it out to be, and maybe it hasn't really fulfilled its pullback that I was expecting. Remember, I was thinking the market should pull back a fair way. It's gone 19%, and you never know, it might fall down, move down and come down to around 20-25% from that all-time high. Now at this point in time I'm not 100% sure, but right now it is bullish, and I think it might continue to be bullish, but we'll know in the next couple of weeks if it breaks through that high. If it doesn't and start to fall over, it will go through that low or down towards that low. If it goes lower than that, then we're likely to see like a 20-25% fall from that high, which would take it somewhere down around just under 20,000, around to 19,800-ish. It may go a little bit further, but I doubt it, but it's definitely not going to crash, and that's one of those things that people talk about. So let's go and look at the stocks. Now, I've got a couple of stocks. I've got a question here from Jazz Mac. So while I bring up the stocks, where are we there? He asks about Disney, and he's talking about, he said, just started subscribing. So thanks, Jazza, for that. And just started subscribing. What are your thoughts on Disney, their new acquisition, streaming services and potential growth? I think they've got a lot of potential, Disney, for their potential growth, because obviously they're trying to take on Netflix, stand those sorts of streaming channels. And I think the content they have is very, very valuable. And putting that through a streaming service is just really what the doctor ordered. And we can see here how this massive move that this stock has had over the last few weeks. So if you put my little magic tool on it, you can see here it's risen massively over the last few weeks, 30% in 1, 2, 3, 4 weeks, and nothing looks like it's going to stop it at this point in time. So I do really like this stock at this point in time. What I would expect, you're going to, because it's been so volatile in the last few weeks, and you can see here it doesn't normally go that hard and fast over a few weeks. It's had a big drop here, but no big upward movements other than here's a big bar here. But most of the time it's very steady, as you can see here. So what I would suggest over the next few weeks is, if you're not in this stock, it's probably best to sit back and wait for it to retrace, and it probably will retrace. It'll probably pop back down somewhere around where that says 30.38, so it'll probably pop down to about 122, 125, 126 over a couple of weeks, and then once it starts to turn up again, you might be able to pick it up then at a little bit cheaper price than it is right now. But great question. I do think it's got a lot of upside over the long period. Disney is a big company. It's a well-managed company. And it's one of the biggest on the S&P 500, obviously, and the Dow. So, and I did trade this in my book, Accelerate Your Wealth, and it did very well. And if you haven't purchased my book, Accelerate Your Wealth, there's 2 editions. There's a US edition where I cover all of the Dow stocks. If you love the Dow stocks or the US market, then you can get that book on Amazon or iTunes and in local bookstores all at the US. So, and I have had a lot of feedback from people buying it in the US saying finally they understand the market now and simplifying it for them. But there is an Australian book where I look at the Australian top 20 stocks as well. We can buy those in bookstores in Australia as well. But let's look at a couple of others. There's still a couple of others I want to look at. I want to look at IBM and Microsoft, and 2 of those big long-standing IT companies that we've got. And you can see here how IBM is one of those magic companies, but it actually has its all-time high way back in March 2013. So 6 years it's been falling away. And when a stock's been falling away that long, it normally starts to signal that it's probably going to have its low and start a new uptrend. 6 years is a long time for a stock to be falling, and you can see here how IBM doesn't normally fall for that longer period of time. There's July 1999 down to, October 2002, 3 years, and then there's a big fall in its early days here. There's probably another 3 or 4 years there. January 91 to around about 93 is another couple of years. So this is a massive, massive fall. And it's fallen into this level through here with all of this stuff, all this support through here. So I would suggest this is a really good stock to look at this point in time and stick this in your portfolio. Right now, I would suggest we're going to have maybe 1 month down, maybe 2 months down, and start to move up again. And we're seeing that at the moment. If you're looking on the right-hand side of the chart there, we're getting a little bit of downward move. Once this downward move finishes, and I would suggest it's probably going to find some support. I'll just put my little tool on here, and you'll probably find support around that 130. If it does do that, starts to move up, it'd be a nice stock to put into your portfolio at this point in time, like IBM. I wanted to cover Berkshire Hathaway. Now, most people can't afford to buy Berkshire Hathaway A shares. They're the ones that are worth hundreds of thousands of dollars. Most people are getting into the B shares, which is what you're seeing here. So Berkshire Hathaway B shares, Warren Buffett's company. This is a company that's more of a buy and hold type of company for your portfolio. It's good for underpinning the portfolio growth. Often when people buy stocks for portfolios, they don't think about the portfolio itself. They just buy stocks that they think will fit. Or they just like at the particular time. And sometimes they're creating a very volatile portfolio. Berkshire Hathaway is a stock that you put in to really underpin. You want to get some stocks that are very low volatility but good steady stocks for trending stocks, and so they'll continually add to that bottom line for yourself. And this one is exactly what we're talking about here, so it's looking quite nice. I think it's going to go through its all-time high from December last year. It'll start moving up through that, and you'll make a consistent percentage profit on this year in, year out. So nice looking stock here for those who like a bit more medium to longer term in their portfolio. You can see here it just trends quite well. The last stock I want to look at is Microsoft. Again, look at this. This is a beautiful, beautiful stock, and it's heading north at this particular time. Let's just go to the weekly chart, and you can see here it just keeps moving, and now it's going a little bit more vertical. It's going a bit fast in my book, but still a nice looking stock. Again, a very similar view to this as I had with IBM. It has moved up over the last 4 months. It's doing a very, very nice uptrend. Its low is back in that GFC low back from March 2009, but I think you can't do much better than a stock like this in your portfolio for medium to longer term growth. So things like Berkshire Hathaway, Microsoft, IBM, very, very good stocks, and Disney, another great stock for a portfolio. Just have a quick look at the weekly chart on this, just to have a bit of a look on here. It has been going quite strong, and let's put my little pointer on here, and you can see since this low back in December, it's now up 38%, so very, very good looking stock. I would suggest it's probably going to have 1 or 2 weeks down, or it'll pop down for a little bit and then start to move again. But right now, there's no reason not to have this in a good portfolio for the medium to longer term. All right, so that's it for me for this week. But if you do want me to look at some stocks for you, so the US stocks, plonk them down below in that little chat box. You can put your comments down there. Tell me what you like about the stock, what you don't like about the stock, why you're thinking of buying it, anything that you think is relevant to me, because the more I know about you and what you're thinking, the better, the more I can help you. But do stick it down there. Remember to subscribe to the videos, or subscribe to our channel so you keep up to date. But for now, goodbye, good luck, and good trading.